Hey everybody, Marty Mazar. Good morning. 11th of April, 2017, your weekly video. I've got a lot I want to share with you today, so I'm going to run through it very quickly. I don't want to keep you too long, and I want to keep your attention. I think this stuff's important. Paul Tudor Jones has one strong rule, and that is when it comes to a stock, if it's above the 200-day moving average, he's going to be long it. And if it's below it, he's either not going to own it or he's going to be short it. Period. End of story. And he just lets that govern every single thing that he does. Paul Tudor Jones sits prominently on the Forbes 400 richest people list. He made his billions in the markets. As you know, I sympathize greatly with the importance of the 200-day moving average as a technical indicator. Here's the S&P 500 since 1990. When it trades above the 200-day moving average, as Mr. Jones suggests, good things tend to happen. When it trades below it, not so much. I would add that when it trades below it and it's sloping downward, not so much. You get a lot of breaks when we're in a bull market that do not suggest that we should be reacting to them. But when it's down, that's a whole nother story. And same thing when it slopes up. So as you can see, very important to pay attention to that over the long term. And here it sits today, comfortably above it with a nice upward slope. Other markets that we focus on, Europe, Australasia, and the Far East, very important indicator for that index and that part of our portfolio. Here's how it looks today, very constructive. Emerging markets as well. It's a very robust indicator. You can use it across markets. Here we had a lot of noise, so not a lot of help in here. Here we are today, though, with a very good, strong, constructive look in emerging markets. I want to look at just the major sectors that we have a 15% or greater allocation to. Financials, as you can see, got to respect that 200-day moving average. Here it is today. In technology stocks as well. Here it is today. Industrials today. Materials today. What about gold? That super safe haven. A lot of people are interested in gold. It's been kind of all over the place lately. Very robust indicator again. Works for gold, as you can see. Here gold sits today, really trying to penetrate above that 200-day moving average. I noticed this morning gold was up about $5. I also know that there are U.S. warships heading to the Korean Peninsula. That's the kind of news that's going to be bullish for gold in the near term. Don't like the technical look of gold right now going forward. How about silver? People ask me a lot about silver. We've used it in the past. There is some major correlation to gold, as you can see, but silver does have a strong industrial application as well. So if you had to own one or the other and the economy's doing well, I would say own silver. Struggling with that 200-day moving average right now. What about industrial commodities that don't have that precious metal safe haven aspect, that they really are good global indicators of the economy? 200-day moving average works well there as well. Here we are now with a very constructive look with industrial commodities. How do other asset classes square with industrial commodities? There's the S&P 500. You can see pretty strong correlation, but keep in mind, folks, that the U.S. is not an industrial economy. We are a services economy. So times here, like when China basically decided to try to become a services economy and stopped buying the world's commodities, you had a real bear market that did not coincide with a recession, which such a bear market in commodities tends to do. We spent a lot of time analyzing this last year here on the blog. But here you have now that correlation kind of resuming with the U.S., Europe, Australasia, and the Far East. Also developed nations, less commodity dependent, so you don't always have to have this correlation, but you can see the fact that this does speak to the health of the global economy. You are going to see some of that correlation, and we do see a good look there. Emerging markets, those who are still in their industrial phase, they are very closely correlated to commodities. This is the best part of our portfolio so far this year. A lot of noise in here, but I watch commodities very closely as I think about emerging markets. In terms of treasuries, there's some messages there as well. There tends to be some negative correlation, or not nearly as correlated as global equity markets are to commodities or industrial commodities. And here you see that very vividly. Although you had some periods in here where they went in the same direction, right now I would say one or the other, as we continue to trend forward, is going to have to give up the ghost. Either the global economy is not as in good a shape as commodities prices would suggest, and you're going to see that begin to wane and come down while bonds start rising again and move into a new bull market, or bonds will have to give up the ghost ultimately, and time will tell. The interactive chart that I want to get to is going to be this. I'm going to use the Fibonacci retracements to talk about where we are right now. And are we solidly in an upward trending bull market, or do we need to be concerned about overall breakdowns? These retracement levels are something that technical traders respect greatly, and I'm going to illustrate that for you here live in a second. 38, 50, and 62% retracements are the ones to keep your eye on. Here's a live chart this morning. Here's the 200-day moving average. Let's bring in these retracement levels. And what I want to do is just kind of retrace this bull market all the way back to when it started in 2009 and show you how important these levels have been and what they've sparked in terms of the trading. So here we start in March 2009. We'll move to the peak in 2010. You can see the market began giving up the ghost, flattening out of the 200-day moving average, although it didn't really roll over. And look at that. The market just stopped dead right at that 38.2 retracement. Traders bought it, tried to test it again, and then we were off, setting new highs for the bull market. So we can move it up to this point here if I don't mess it up. There we go. We move it up to this peak there. And you can see we test that retracement level once again and then bounce off of it. So what you do is you just kind of keep moving this line up. So now we're safely above any retracement levels from that old low. So we move up here to that bottom of the 2011 correction. And we can see that when we come to this point, sure enough, we retrace and retrace right back at that 38% if we want to leave the starting point where it is and just move up here. Came close. We see the 200-day moving average providing support and never broke down far enough to test a 38.2% retracement. Let me fast forward quite a ways here. We had somewhat of a little bump there in 2014. So if I go back here to this low, and make that our starting point. No, nothing close. It was the 200-day moving average that held for technicians. We go back up here to the peak before that 10% correction we had in late 2015. And you can see there, we did test that 38.2% retracement from this level here. If we move up here, we actually broke down below the 200-day moving average and ultimately tested a 100% retracement before bouncing off of that. And we did have the 200-day rolling over. Now, I spent time on the video looking at this. And what I illustrated for you was the macroeconomic setup was very different here than it was before the last two bear markets where the 200-day rolled over. We just didn't have the right economic setup to suggest that we should be moving into the next great bear market. So you move fast forward, if you will, to the low in February. Move it up to the current. So again, we're not threatening the 200-day line yet, and we're nowhere close to the 38.2% retracement. So folks, what I'm saying here is that a lot of volatility, a lot of noise can happen, and it very well may, and I suspect during the year that we will test these levels at some point, because we normally do in the course of all bull markets. But right now, with all the stuff that's going on in the world, all the concerning rhetoric and so on, the stock market, anyway, is sending us a signal that we're very much in a bull market. And until we come down and breach some of these very important technical areas, we have to assume that ultimately we're going to move out of this consolidation and into new all-time highs. And that's based on the data we have at our disposal today. Things can change, and as they do, I'll be here to report them to you. Have a great day. As always, thank you so much for watching and listening, and look for the weekend message here by the end of the week. Take care. Bye-bye.